All right, everyone. Welcome to another webinar for Viking Capital. I'm so excited. My name is Vikram Raya. I'm the CEO and co-founder of this company. I'm glad to welcome my two co-hosts, Judah and Christopher. Let's get them pinned, team. And before I get started, I just want to chat a little bit about sort of the state of the economy, state of the world. Special day. There's a debates going on after this. So I consider us, this is tailgating for the debate, I guess. But yeah, I just wanted to, I'm in a unique position. Did not participate in 2008 as a real estate investor. I was a homeowner at that time. And it's been many years since that time. And we've had so many economic cycles. We've got to be sort of front seat and center as a real estate investment company throughout all of them. And I just wanted to give you my thoughts. And also, I'll get feedback both from Chris and Judah regarding this. But as I study history, what we found is the most amount of money is made during maximum pessimism. And if that's true, then I think maximum amount of pessimism, because we've sort of gauged the fear, if you will, in real estate and stocks and things like that. And the most amount of fear is probably during early to mid 2024. We think that was really the bottom. It's hard to predict the bottom when it's happening, but as you project forward, you can sort of look back and see where the dots connected. And early this year, we thought the bottom will be at some point in Q1 and Q2. And we made a decision. We made an investment thesis, and I consulted with Judah. I consulted with Chris, consulted with Ravi and my team. We said, hey, look, we're going to lean into this and really go after opportunities. And while other people are fearful, we will be opportunistic, if you will. And so we ended up going in and purchasing deals at phenomenal bases. And we ended up, will be the fifth deal we've done this year, which is the most we've ever done. And I think this is a year to really swing for the fences because the deals actually make sense for a lot of times where it's very hard to find deals that actually pencil out. And so as we look at the history and we look at these patterns and look back at the market, I think the peak of the market previous to this was late 2021. And the reason for that was there's low interest rates, right? There was a strong rental demand. There's supply chain issues. And all of this created this frenzy and people were in a buying upward spiral. And now we're in a very interesting time, right? There's volatile election season. There's geopolitical risk across the globe, supply chain issues. And after these 2 years of historic tightening cycle, rates are finally starting to come down. And right now, the Fed plans to follow up their half a point rate hike with another quarter point in November. And so what this really means is a soft landing is imminent unless further notice. And so what does that mean for investors? Well, a lot of investors, especially the ultra high net worths that we have in our investor pool and the high net worth individuals, as well as a lot of the institutions, were sitting on the sidelines. But now, and they were enjoying treasuries and T-bonds, like all these safer investment vehicles. But now as yields are dropping, as rates are dropping, they will need to seek yield. And what that means is they're going to re-enter the market. And obviously stocks are one option, but besides that, real estate is another option. And look, it'd be great to invest internationally, Europe, possibly China, Russia, right? But there's challenges abroad. And so that's why we believe here at Viking that US still remains a reliable source of growth, stability, and resilience in the investment landscape. And so I'm not going to try to paint a rosy picture throughout, right? There are challenges in commercial real estate. Let's not be fairy tales about it, but office is taking a seismic hit and it will continue to take a seismic hit for a couple of years. Retail is slowly recovering. Industrial, student housing, hotels, they're relatively stable. But what we've seen is this is where the big money players are. The smart money is going. 40% of the institutional capital is going into commercial real estate, specifically multifamily. And this is proven by some of the big purchases by Brookfield, by Apollo, by Blackstone, Equity Residential. And some of the other challenges obviously are there is floating rate debt out there. But the interesting thing is the huge 2008-like crisis that a lot of people predicted is not panning out. There is no meltdown predicted. And the reason is they're restructuring debt, there's loan modifications. And as the rates drop, eventually people will try to figure out how to either sell the property or refinance it. And so at this point, the two buzzwords that we at Viking Capital are looking at are basis and flight to safety. Let's talk about basis. All the deals we bought this year were at a significant discount compared to replacement cost. And flight to safety, what does that mean? People want nicer, larger, newer assets. And if you look at our 2024 track record, Bluebonnet, the deal we'll be presenting to you guys today, fits that mold. And so with that last comment, I just want to, first of all, say, hey, as we're approaching our 10th year anniversary, I want to thank all of the team. I want to thank my partner. I want to thank all the Viking investors that have been with us since the beginning. And it's just been an honor and a pleasure to be on this wealth journey with you guys as we're trying to find the best deals out there and supporting you and just trying to be investor centric. And we couldn't have done it without our support, without the loyal investor base that we have. And we continue to try to do our best to serve you all. So thank you again. And then with that said, let's put in the chat box. I want to make sure the chat box works. Where the heck in the country are you guys? Put in the chat box. Where in the country are you guys calling from? Okay, we got Tim from Arizona. We got Boise, Idaho. We got Barbersville, West Virginia. Sanjay, Miami, Michael. We got Ram. Where's Ram from? Ram is from Dallas. Good, he's local. Santiago from Florida. Awesome, guys. Thank you. And let me kick it off to my co-hosts, Judah and Chris. And any words of wisdom before we start this train?
Yeah, thanks, Vic. I agree with a lot of what you said. We have been active over the last 24 months when a lot of groups have been on the sidelines. Not only has it allowed us to differentiate ourselves in the market, but we've been kind of sharpening our swords, honing our skills over the last 24 months. And as deals come out at cap rates higher than they've been in 4 or 5 years, at basis lower than they've been in 36, 48 months, we are on top of all the market trends and all the assumptions going to the underwriting. We are best prepared compared to a lot of groups out there, take advantage of some of those better deals in the market. In this case this property we're about to discuss, really being case in point.
And Judah, you want to give a one-liner about your background, and then we'll get Chris to give his background and his take on things.
Yeah, sure. I'm coming on 5 years with Viking, and it's really been a great run here. I've been able to use a lot of my background. Originally, I was on the legal side of the profession before doing more real estate law, before doing underwriting for a capital markets advisory group, and then coming on to Viking. So really bringing the kind of detail-oriented approach I learned in law school and practicing law, combining it with kind of a natural inclination. I've always enjoyed the underwriting, the puzzle that you figure out when you're looking at investment, and pairing that with kind of Viking's initiative and Vic and Robbie's leadership and great teammates like Chris. It's been a great ride so far.
Awesome. Okay, Chris, share a little bit about your background and then tell me your take on things.
Yeah, absolutely. So my background, I've spent the last decade working in private equity, both in the US and internationally. Hotel development, multifamily acquisitions, development, you name it. Capital raising and working with investors is really where I spent most of my career. I think the big take here, I agree with what Vic and Judah have brought to light, but big shout out to you, all of our investors. As I talk to my contemporaries in more institutional areas of private equity, what has allowed us to be nimble and really fundraise and close on these deals and take advantage of the opportunity is the support from our investor base. A lot of folks that rely on more institutional capital haven't had the luxury of being able to attack this soft spot of the market and really be able to attack these deals. So thank you all for believing in us and helping us build your trust.
Okay. Let's go to our portfolio performance. So especially during this volatile season, I'm really proud of this fact that we've never lost a single investor dollar. We've never made a single capital call, and we continue to really focus on capital preservation. That being said, we also want to make a profit for everyone, and offense is important. And so we'll share with you why this deal makes a lot of sense. 29 deals done so far. When we close on this deal, we're crossing the $1 billion of assets acquired, which was a big milestone in our eyes. And so we're excited. That being said, I've talked to some of my friends and colleagues, and they're like, oh, you're about to hit $1 billion. Great. You're about to get started. I'm like, thanks. The difference between, I think, success and failure sometimes comes down to the team. This team was hand-built, was specifically selected for their skill sets, for their work ethic, for their core values. And so we really assembled a team that our goal is to provide institutional level opportunities and service with that white glove feel. And I think we're well on our way to accomplishing that objective. So I really want to thank my team. It is very diverse. We have asset management, acquisitions, marketing, investor relations, research, analysis, all of it. And so I'm going to hand it off to Judah, and he's going to discuss a little bit about what is really driving the demand right now in our markets.
Yeah, thanks, Vic. There are a lot of factors that really drive the multifamily market, the apartment market. And unlike really esoteric, far out there investment fields, this is an area that a lot of our investors can really relate to. A lot of you have lived in apartments, may still live in an apartment. Some people are rent by necessity. Some people are rent by choice. A large, overwhelming majority of the rental community is rent by necessity. People who, for whatever reason, can't afford a home. And that percentage is only growing. Seen in this chart here that was put in the Wall Street Journal, that there really has never been a worse time to buy a house. Between supply being down and interest rates being up, no one wants to sell. And if you do have to buy a home and you find one you like, your mortgage payments are so much higher. So the premium, and that's kind of the going over 50, right? The premium at 150% compared to renting a home has never been higher. So driving people of all swaths of the socioeconomic world into rental apartments, into multifamily. And just so you don't think, okay, that's America, very nice, but this deal's in Texas, this deal's in Dallas. Well, you can see here that the price surge that Texas home buyers have faced has mirrored that of the U.S. market in general. So everything we're telling you that's nationwide, that you're experiencing wherever you live, I saw all those cities come into the chat box when Vic asked where you guys are. You're probably seeing it all in your markets. It's here as well, and it's driving the success of the multifamily in Dallas as well. And just give you an idea, rent versus buy, right? Because what are we really talking about here? We're talking about monthly payments. Your average home price is well over $350,000 in the Dallas-Fort Worth area, 5% above the national average. Your average monthly rent, though, is just under $1,800, 14% below the national average. So that actual gap is actually a little wider in Dallas-Fort Worth than is the rest of the country. There has been a lot of multifamily developed in this market because it's great need, and it offers that savings to rent an apartment versus buying a house. Again, what's driving all that development is that the Dallas-Fort Worth population is growing, right? Things are bigger in Texas. That'll be a theme throughout this presentation to some degree, but the population has been growing. People are moving to Dallas. People are moving to Fort Worth, driven by all the jobs coming there, the corporate relocation, the lack of income tax. There are a lot of reasons why people are moving to DFW. Literally a person every 3.3 minutes. That's crazy. That means, well, while we're on this webinar, you can imagine how many people are moving to DFW. And guess what? Probably 75% of them are needing an apartment. And this is just a nice way to look at kind of another way to slice and dice the data. This was a great chart, infographic that Marcus and Milchap put out. And they have a very deep team of economists, and we even had one of them on our podcast once. But basically, the children of baby boomers are unsurprisingly a large generation as well. They're delaying marriage, they're delaying their first home purchase, and that 72.1 million people you see there, that peak in the population for people aged 25 to early 40s, they're not buying houses the rate they used to be. They're delaying it. They don't know where they want to live. They can move around more. They work remotely. They're not having kids as young. They don't need a house necessarily. All this is just fueling that apartment demand, specifically the highest concentration in that kind of millennial and Generation Z population. And then this is just kind of shows you the world that we play in. We're not the only people to feel this way. Over 9 billion in transactions, more than half of Dallas's real estate transactions. And I have colleagues that invest in industrial, in office, in self-storage, in retail. More than half of it is in multifamily, because the overwhelming consensus of those kind of in the real estate space are where that DFW is the market, and multifamily is where there's that strong appetite, that kind of risk mitigation with plenty of upside.
And just to stack on what Judah's saying, you guys know that we're very well established in Atlanta. And the interesting thing is this Dallas-Fort Worth market mimics Atlanta quite well.
And then despite everything I've been saying, despite all these units that have been built in order to accommodate the people moving there, despite this kind of awareness of the need for apartments, there's still a shortage. There still are not enough multifamily apartments in the DFW area to provide an apartment to everyone who's looking for an apartment. And that delta, that difference, that demand outstripping supply is what helps mitigate the risk of investing in multifamily in this kind of market. And then again, some of the things that are driving people to rent, what they're looking for in these rental units. They want to have flight to quality, Vic mentioned earlier. They want to have a modern design. They want to have nicer units, higher quality, newer product, right? Not something that was necessarily built 40, 50 years ago, something that was built recently that'll appeal to their tastes. 3 to 4 bedrooms. People are looking to buying a house. That was one of the big themes you'll hear in this webinar. They want to grow in their apartment. They want to have to move from a studio to a 1-bedroom. When they get married, they have a kid, a 2-bedroom, a second kid, a 3-bedroom. They can find a big enough apartment, they can just park themselves and really establish their lives in some of these larger, nicer units. They would like to have that space, but not have to take care of it. They don't want to have to fix the roof. They don't have to fix the siding, power wash the deck, mow the lawn. That's one of the appeals of apartment life. So again, kind of spaces that mimic the lives they want to build, but more low maintenance. And obviously near markets that they want to live in. And that's where we get to BTR. Vic joked before we were prepping that single family homes and apartments had a baby. BTR is what it would look like. Now, BTR is a new space in the market. It's called build to rent. Aren't all apartments built to rent? Yes, but they're built on a unit by unit basis. You have single family homes, you have townhomes, The idea is that these are more for long-term rentals to compete with housing. So people aren't just renting instead of housing because they can't afford it, but they're actually going to rent because it's more convenient. They get all the same benefits with less of the headache, and they can afford it. And that hits all the features we just spoke about. Again, and these are some of the things driving this market. It's not just the rent by necessity you heard me talk about earlier. You also have people who want to rent by choice. They can now have a big home, a townhome, a single family home. They can have something that they can live in for many years, even though they could afford a house, just less of a headache. Think of someone downsizing. Think of a professor moving to, they know they can be somewhere only for a few years. Think of something moving to a market, but they don't know where they want to live yet. They want to really test out a neighborhood and see if their kids like the school, maybe even the middle school, before they invest long-term in a community. And these shifting demographics to younger and middle-aged people, again, they're more versatile. They want to be able to work from home. They don't just want a one bedroom with a small den. They want to have maybe a second bedroom, even though only one person, because that's their office. Things you only used to see in houses, you're now seeing in apartments. And again, the high interest rates keeping that cost of the owning the home up. They get all the same benefits for a much more affordable price in a BTR rental. Not surprisingly then, look at this surge in demand and in construction of BTR units over the last really year and a half. 2014, 2020, no surprise, kind of when COVID hit, it was relatively flat in terms of 7,000 units built a year. COVID accelerated everything. One thing accelerated is this demand and supply of BTR. As you can see the surge, the really steep increase, 300%. And again, you can see on the bottom here, I urge you to rewatch this webinar because, as I mentioned before, BTR provides the privacy, the single-family lifestyle at the more affordable price point. And there's been such a strong demand in the market that most of these properties lease up faster than a regular multifamily property would lease up.
So yeah, I mean, we heard all of the reasons why tenants love build to rent. And I think investors, especially institutional investors, have been listening, hence the surge that we saw in the last slide. But even for our LPs, and I was speaking with a family office recently that focuses on BTR development, and it's just such a much lower risk and risk-adjusted return. So a few of the things that build-to-rent properties offer investors specifically are lower deferred maintenance. You're dealing with larger units, but typically lower unit overall in the complex. And you're also going to have an appreciation that's more correlated to single family with multiple exit strategies. So we could sell this thing as a multifamily property 5 years down the road, or we could also sell this individually out as single family homes that are connected. You also have a much better tenant base. These properties are a little bit more expensive in order to qualify for these rents. And really the folks that are looking for a 3-4 bedroom home to move in all of that furniture, you're really getting a better tenant base, and you're getting a tenant base that really intends on staying. So you don't have as much loss to lease. You don't have a lot of the issues that you might have with a 90s or an early really 80s, 90s value add. There's a lot of turnover in those apartments. You don't really see that here. And all of that provides a much stronger risk profile and a safer investment.
All right, guys. And that lends us to this latest investment offering, our 30th investment offering. That's a beautiful skyline of Dallas there. And then boom, the townhomes at Blue Bonnet Trails. We've been scouring the market for a BTR that made sense to us. And Judah found one in Dallas. It's in southern Dallas in a up and coming emerging market in Waxahachie, Ellis County. This is 114 units, 1,800 square feet, average unit size. I mean, this looks like almost a fictitious neighborhood here. A white picket fence. I definitely want like the third house on the left here. I'd probably live there. That's a good house. So let's go to, all right. This is exactly why we love this deal. Number one, we've entered the Dallas-Fort Worth market as a joint venture in the past, but we really wanted to come in and sort of put the Viking flag down, and we did. This deal hits all the criteria we wanted. We wanted a top location. DFW fits that. Tons of migration, tons of growth, tons of jobs. It's a high quality asset. I mean, this was built literally like 2 or 3 years ago. There's no deferred maintenance. It shows well. It's 97% occupied. There's probably a wait list to get into this thing. And then thirdly, it is a core plus strategy. What does that mean? Again, we talked about nicer, newer vintages. That's what we're talking about. This is essentially an A class property that attracts a higher level tenant base. And so this affluent renter profile, we don't have to worry about them not paying their rents and things like that. This is a different level profile. And so hence the risk is way low for our investor base. We also want to make sure that this appreciates in value. And so the sub-market is what we've analyzed very in detail. And there is a growth trajectory we're seeing around this complex. So not only is the asset extraordinary, but the sub-market is as well. Okay. There's another picture. As I mentioned, the details, it was built in 2020 initially, and then the last building was constructed in 2021. So essentially 3 years ago, 114 units, average square foot, 1,843 square feet. So this is large, essentially equivalent to a home, and it's really widespread density. So it feels very spacious for our tenant base. Also, there are two car garages with every single home. And so there's 228 parking spaces. Now let's get into the numbers. This cap rate we got the deal at is almost at a 6% cap rate based on T3 numbers. The expense ratio is 49%. What that means is normally expense ratios at 60, 70%. This is only 49%. It's easier to maintain this kind of property. One, because it's newer. Two, because of the type of property it is, which is like a single family home. And then finally, the physical occupancy, 97%. People really want to live in these kinds of places. And as Judah mentioned, the 100,000 unit shortage in DFW is promoting this high occupancy. One of the safety measures we look at is something called DSCR. Many of you established investors know this criteria. I'll just quickly review. It's debt service coverage ratio. Essentially, how much income does a property make compared to the debt service or the mortgage payment? The bigger the number, the safer the property. And we like to be above like 1.3, 1.4, 1.5. This is close to 1.8. So that's how it's almost twice the income to cover the rent. Purchase price 35.2 million, hold period 5 years, and we'll go through the tranches of equity needed to close the deal in a second. Another beautiful picture. And I think this is our good
Yeah,
friend.
I'm happy to jump in here. So, some of you may be thinking to yourselves, listen, I remember when Viking used to buy these older properties that they can add value, they can increase rents, and they had to do so by these pictures where there were some uglier pictures and there's some beautiful pictures of what we were going to create. One of the great things about this deal, like a couple of the other deals we've already begun to execute on, is that it has a lower risk profile of a new deal, but the upside of those value add deals. And we'll get into that graph in a little bit. But here's where the upside is. Rents are simply low, right? These people bought this property a number of years ago, right when it was built. It probably was not fully occupied yet. They added their value by filling all the units. And one of the ways they did that is by keeping rents lower than they were in the market. And now we have the opportunity to come in. It's fully stabilized. Operations really humming along nicely. Rents are simply low. Average in place, just about 24.55. Average market rents in the market, almost 2,700. And all that means that we get to go in right now and start raising rents to market where they should be. And that's a beautiful delta. $250, $240 per unit per month is a tremendous upside. We usually have to spend about $12,000, maybe $18,000 in order to get that type of upside. So again, higher risk, lower risk, higher reward. And that's what's so attractive here. Large units, as Vic said, a newer property. Tenants have spoken loud and clear over the last couple of years as pricing power has moved back in their favor, with rents no longer jumping 20% a year. They want to place their rent dollars in nicer, newer properties. And this is certainly one of those properties. This is what I was talking about before. This is kind of the spectrum of multifamily and even real estate risk reward profile. The more core your property is, the lower the risk, the lower the reward. When you buy a piece of dirt and you build a new property, you could have very high reward, but there's no building there. There's a lot of work has to be done even just to create the value. Core plus and value add are two sides of the same coin. Value add being there's more, it's heavier lift. You got to go inside, you got to tear out cabinets, you got to replace countertops, you have to redo the amenities, maybe even change over the tenant profile because it's a new quality property. Core plus is where you come in and there's some work to do, not much, and there's maybe a little bit less upside. And if you can see where the orange dot is, there is an overlap in those two. And if you can find a property in that overlap, you're finding the core plus risk profile, a lower risk, but the value add level returns. And that is what enables a property like this to get me and Viking and our investors so excited. The upside that we're all used to while mitigating risk. Double car attached garages with inside unit entry. Again, you sometimes are happy to find a property where half of the units have garages. You're happy if a quarter of those you can access from inside the unit, as opposed to having to go outside and manually open the garage. Here, every single unit has a 2-car garage. It's actually on the back side of the units. So that means it leaves the front of their property open for a yard.
Thanks, Judah. One thing I wanted to point out, many of you might not know this, but this particular webinar is really only marketed to our internal list. So folks that already have a relationship with Viking. There'll be another webinar to the general public in a few weeks, but we have put the link to book a call with myself or someone on my team in the chat. So do take advantage of that because you pretty much have a 2-week head start on getting in front of this and making a commitment, whether that's Class A or reserve that typically run out quickly. That being said, this is common to most of you that are on our list. This is our typical capital structure. You have the capital stack on the left with the debt on the bottom. You have Class A, which is going to be a 10% preferred return. It's also prioritized over cash flow in B and reserve, but you're giving up the equity split. So the profit split at disposition, participate in, but you have a pretty good feeling that you have a much better chance of getting your Class A secure, and you're taking on a little less risk at a pretty high cost. Class B and reserve, they're structured the same way. So cash flow is pari passu, which is going to be that 5.64% average cash on cash. It'll trail up through the whole period, but the difference between B and reserve is going to be the investment amount. A 50K minimum for Class B, and reserve is 500,000 and has slightly higher economics. On the right, you'll see the purchase price. You'll see what we anticipate as far as a debt quote, and you'll see what we anticipate as a total equity coming into the deal, and then a breakdown of the return metrics down below. So here we do a walkthrough. So this is really comparing a $100,000 investment in Class A with those dynamics that we just chatted about, Class B at 100,000, and then reserve at its minimum, which is 500,000. So you see in Class A, you invest $100,000 starting in year one, you're collecting that 10%, which equals a $10,000 payment that's broken down into 12 monthly distributions. And that goes on through year 5. When we get to the disposition year in year 5, you've received the returns that you're due. So you have the repayment of the $100,000 you invested, and you've achieved a 1.5x multiple. For Class B, you're getting slightly less in the cash flow. So you see it starts at 5,000 and trails up to 6,500 annually. So still same division by 12 for monthly payments, but you're getting that equity split of 70-30, which adds on $60,226. So you can see for the same hold period and the same investment amount, you're getting an extra $38,412. You're taking on a little bit more risk, but you're getting a pretty nice reward for it, as it should be. Reserve class is going to follow the same dynamics as Class B, except the equity split is going to shift from 70-30 to 80-20. So you see it's 5 times the investment, so the distributions look a little bit more, but they're the same percentage. But you can see you're getting closer to a 1.98 instead of a 1.8 equity multiple by investing through reserve. Like I said, reach out to my team. We can dive through this more if you have more questions. So one of the other benefits of these deals is the bonus depreciation. What we do every time we acquire one of these properties is a cost segregation study. And what that allows us to do is accelerate the depreciation from the overall asset. You basically get to take the straight line depreciation, and for certain tranches and buckets of things that depreciate at a lower rate, get accelerated into year one. So what the IRS has allowed for over the last few years was 100% bonus depreciation. So if the property creates 10 million and it's 100% bonus depreciation, you divide that 10 million by the amount of equity that comes into the deal, and that is the percentage that you get from your investment amount. Now that we're in 2024, it's been lowered to 60%. So that same $10 million of depreciation, we can now capture $6 million of bonus depreciation. So that $6 million will get divided by the same amount of equity. It'll be a lower amount, but also keep in mind, as we go through the other years of this period, now that we're only accelerating 60%, there's more on the back end years. So it's not all lost. But keep in mind that moving into 2025, the step down is going to continue. So it's 60% this year through the end of the year. So any property that's acquired before January 1st will qualify for 60%. Starting January 1st through 2025, that same $10 million of depreciation is now only going to capture $4 million of depreciation. So if you're focused on offsetting passive losses, the next few months will be crucial. Sensitivity analysis. So once again, I implore you all to go to the link that's in there and book a call with me. I'd be happy to walk you through the entire modeling. And I usually put a video together that everyone can watch and kind of understand our thought process through the financial model. But with the sensitivity analysis, really what we're showing here is how the exit cap rate correlates to the exit price and the returns. So we've been pretty conservative in modeling this thing out to a 5 cap exit. As interest rates come down, cap rates are expected to compress. But really what every investor has to do, and this if you've talked to me, I implore you to choose where you think cap rates will be in 5 years. Build your thesis and then use these sensitivity tables to help drive your floor, your ceiling of where you think your investment's going to land. So this one's specifically for Class B, the next one specifically for reserve, but same concept. When you guys review this deck on your own time, look at these cap rates and kind of see what impact 10 or 20 basis points in exit cap really makes on the overall exit price.
Yeah, thanks, Chris. We put a lot of time into that underwriting, and I'm happy we shared that with investors. All right, so financing. We are, like other properties, we're using an accretive loan to buy the property. And again, fortunately, right now, interest rates probably somewhere between a 5 and 5.2, possibly can go lower as rates might go down, and 66% LTV. All these numbers are better than we've seen over the last couple of years. A lot of that's driven by the quality of the asset, strength of the rent roll, but also kind of the near 6% cap rate Vic had mentioned earlier. And that being said, this will be positive leverage, as we mentioned before. We'll be getting an interest rate that's lower than the rate of return on the property, hence making it accretive, one that kind of helps the cash flow. And here is what gets me excited. This is the meat and potatoes of it all. So if you maybe been tuning out a little bit, tune back in right here. This is the business plan. Right now, NOI on the seller's T12 is 1.8 million. Again, by simply raising the rents to market, by instituting a tech package, we're going to install a tech package on the interiors, smart locks, smart thermostats, features that are appealing and in demand by this tenant profile, and that comes with a monthly charge. By just those two kind of relatively simple ways, we'll be taking the revenue from 1.8 million when we buy it. It'll stabilize by year 3, continue to grow to year 5 to 2.8 million. That extra $1 million, again, when you capitalize it at the market cap rate, becomes a $20 million increase in value. That's the business plan. That's what we're excited about. Again, at a newer asset, at a low risk profile. There's a lot in here on expenses, how we're often increasing the expenses from the seller's expenses to be a little more conservative. We'll love to go through this with you. Our team can go through with you, Chris's team, book a call, and in detail or as little detail as you want, we can walk through all this with you so you can really understand what's driving your hard-earned dollars to make that return. And one thing we haven't even mentioned, by the way, is yes, they're big units, but they're 3 and 4 bedrooms. I mentioned earlier, BTR units that have 2 bedrooms are in demand. We have 3 and 4 here. When I toured the property, when we were there already on site for the due diligence, I got pointed out to me where the bus stop is, because this is a top school system, A-rated school system, one of the best ones in DFW. The school bus comes to the property. You have families living here, and they've lived there for a while, and they're going to continue to live there for a while because they can. There's more than enough space. When we were doing diligence, I saw cribs. I saw homework stations, right? People are staying here for a long time, driven by the phenomenal unit mix of 3 and 4 bedrooms. These are not people that are looking to move somewhere for 6 months and skip town. These are people really investing in the community and living here for an extended period of time, increasing the tenancy periods, which, by the way, brings down turn costs and reduces our operational expenses.
And adding on to what you just said, it's not evident from the pictures, but when you visit the property, the entire property is lined with actual single-family homes. It's really part of the same neighborhood. So they're literally directly across the street from the first row. And it really feels like the entire community is part of this broader single-family neighborhood, which is really nice.
And you can just get a sense of the quality of finishes here. Granite countertops, modern shaker cabinets. It's really spacious. Let's keep going through here. Again, there's a kitchen, a full pantry, stainless steel appliances. They get washer dryer hookups. A lot of these units bring their own washer dryers. If not, we will provide them, again, for additional rent. Insanely large closets. The first floor bedroom and the 4 bedrooms have 2 walk-in closets for that first floor bedroom. So again, spacious and meant for that lifestyle that we're looking to attract. And this is the layout of the property. It's compact. It's driving a lot of revenue per acre. And on these gray kind of blocks around it, as Chris mentioned, you have single family homes, 2, 3, 4 bedroom with yards. Again, kids in the neighborhood. It's one seamless area. We benefit from a much larger affluent housing community. Stop here for a second. Large floor plans. Again, this is one where I really encourage you to look at this. Think about your own house, your own apartment. When you look through this, you'll kind of take note of the amount of space these units have and really what kind of life can be lived in it for an extended period of time and why it's worth commanding these top dollar rents. All right, this is a rent comp of the BTRs in DFW. And as you see here, the market rents for BTR, and by the way, the local BTR and local multifamily, it all lines up, but this provides a much bigger data source. Nearly $2,700 per month is the market rent. And again, we're well below that right now. $2 per square foot, and we're at $1.30 per square foot. This gives you an idea of the upside. These are data points that we look for, that we lean on. We're not kind of hoping for an increase, but this is really a measured statistical analysis that supported our investment thesis. And again, we always look at a lot of factors, a lot of angles when looking to buy a property. One of them is replacement cost, right? If someone were to say, I wanted to build this property today, it would cost them $470,000 per unit to build this property. They got to buy the land. They actually have to do the construction. If someone's going to be buying that unit, again, this is per house because we can sell them individually. The developer fee gets baked in. There's all the architecture plans, the engineering plans, and the soft costs. We're getting it for $160,000 discount per unit. So again, when we saw that, we knew there was value intrinsically there as well. As Chris mentioned, each one of these homes is separately parceled. If the DFW housing market continues as it has, exiting at a per unit basis to owner occupiers might be our exit strategy. And again, this is a great little view here. The houses around it, you just see on the bottom are actually the single family homes, and that's the overall community. And by the way, those outer farmlands have started being developed. On the front side of this, where there was grass, they're now putting this little retail center in, which is again going to be very useful to the tenants of the community as this area gets further and further developed. It's always nice to be kind of the first ones in, because the rest of the development will only increase the value of everything already there.
Yeah, there's like an entertainment center across the street that has an IMAX that they just put in.
Yeah.
So it's like
and a bowling alley, movie theater. Yeah,
it's definitely the sort of the new spot in Dallas to live.
And again, now we actually have, there's been 5% rent growth year after year, going back 5 years. We didn't underwrite that. We underwrote less than that, but we certainly think that's achievable. It's certainly proven kind of the concept and our investment that are here. Within 5 miles, you have a large county, you have a ton of access to the DFW area, and all that, the population growth is what's driving the rental demand that you see on the right. And this is where we lie both on the right, kind of focused, hyper local market. The retail around is phenomenal. H-E-B is a great supermarket. We always look at the grocer nearby, the better quality of the grocer. H-E-B, they do their own market research. If they believe in the market, it's proof concept itself. Walmart as well, the good schools that I mentioned, and just quality retail. You'll recognize all those names, all available to the tenants of this property. And on the left, a few things to point out here is the greater Dallas area. We sit on the south. Yes, Dallas itself has all those demand drivers you see on the top 3 squares. I want to focus on the bottom 3 squares for a second. Very close to this property, you have the Baylor Scott White Hospital, less than 5 miles away, driving a ton of jobs this area. They just added 30,000 square feet to their facility, 123 staff beds. It's a growing hospital system. A lot of our investors are physicians. They can understand how a good hospital drives doctors, techs, nurses, PAs, maintenance, all that. They got to live somewhere. They pay better also, and they live in nicer properties. And the South Grove development is a large manufacturing hub. Think of Dallas, we're due south, right off one of the main highways. Think of it as last mile logistics. So anything going to Dallas from the south of Texas, when there are a lot of big markets to the south of Texas, kind of come through here, and they set up, it's more inexpensive, it's more affordable to set up their warehouses here, half hour outside of downtown, which drives all those logistics jobs. Finally, on the left, Blue Star Land Development, Vic will get into in a minute. Owner Jerry Jones of the Dallas Cowboys. They may have lost to my Baltimore Ravens a few days ago, but he's doing much better on the development side. Blue Star is his land company. He's made Frisco into what it is today, and now he's choosing far south Dallas, this area, for his next big development. It's just starting to gain traction in terms of creating jobs, and there's a long runway ahead of him. He does everything bigger and better in Dallas, and our property will benefit from that. I didn't insult any Dallas fans in the webinar, so I'll keep it more appropriate. But again, this is kind of a better map where Dallas sits. You see kind of the south, what I mentioned, anything coming from Austin, San Antonio, Houston, it's coming up through this pipeline right there. Dallas sits really well surrounded by these other main markets. When you're situated in between other large markets, you benefit from them, and Dallas certainly does.
Okay, thank you, Judah. I'm going to bring it home. And guys, I want to make sure we have enough time for Q&A. So I may go through some of these slides a little quicker. And this will be in the investment deck that you could download. It will be on the online magazine you can also look at as well. There'll be a replay. But yeah, I really want to make sure that I answer a lot of the investor questions as well. But I'll probably highlight just some key points. One of the things is it's called the Star. This is the sort of the headquarters for the Cowboys. It is a 91-acre complex created by Blue Star Development, which is Jerry Jones's development company. And its economic impact is in the billions. And what happened was there's a town north of Dallas, which many of you in Texas know, is called Frisco. And it was just a sleepy town. And then suddenly it just became into this bustling center, sort of a the new Dallas, if you will. And so there's the Star, there's Frisco Station, there's something called the Gate, there's Wade Park, essentially entertainment complex, hotel complex, sporting complex, restaurants, shops, office parks, all in a short in a mile radius. Universal has been looking for years to find the next location of one of their parks. They chose Frisco, Dallas, and it's going to open in about 18 months. And this is going to be a huge economic driver. And again, this is all facilitated by Jerry Jones and Blue Star Development, which I'll tell you why is important in a second. The PGA Tour is now having us one of their main events in Frisco and one of these beautiful golf courses, along with hotels and a conference center. So this is Jerry Jones. He is not only the Dallas Cowboys owner, but he is also a driver for North Texas real estate. His company is called Blue Star Land Development, and pretty much where he decides to acquire land essentially sprouts up a new city. So he has proven the concept in Frisco, and now 7 minutes from our asset, Bluebonnet, he is now creating a 120-acre mixed-use business park as his initial inception investment. We'll see what else he develops after that. So statistics about the DFW, second best real estate market in the country based on Price Waterhouse. Median income 75K, 8 million current DFW residents, strong rent growth, 1,500 corporate headquarters, sixth largest economic output in the country, 4 million jobs. Current population is like 7, 8, 9 million. It's going to go through the roof over the years. This is interesting. I don't care. There's an election going on. I'm sure the debates are going to be going on in about an hour. But that being said, you can vote however you like. But when we as Viking are looking to buy real estate, we like to buy in red or purple states because we want to go where it's as landlord friendly. And in this case, this is also very business friendly and worker friendly. There's no state income tax, there's no imposed payroll tax. And 60,000 people moving every year into Dallas-Fort Worth area. Ton of job growth, major employers in Texas. 21 of the Fortune 500 are here. So it is sort of a mecca for attracting top talent, top employers. And this is based on the educational system, the workforce, the infrastructure that's already there. Example of some of the companies that have really had a huge presence in DFW. This is an interesting statistic that I'd love to share with you all. Texas is the world's ninth largest economy with close to 2 trillion in GDP. So as the theme Judah initially highlighted, everything is bigger in Texas. The interesting thing is it's starting to become a headquarters for a lot of companies. And if you go to, I think it's also becoming a huge, please. It's also very diversified economy. There's education, energy and mining, computer manufacturing, business and financial services, defense, security, health, construction, food. So if there's a recession, if there's a correction, if there's a slowdown in certain sectors, it doesn't make a huge dent in Dallas-Fort Worth because they're so diversified. There's jobs everywhere. And the specific property where we're at, there is a diverse group of employers for the asset. And probably as we get the due diligence back, we'll probably find, as what we find in a lot of our properties, a lot of ed and med. What that means is education and medicine, nurses, physicians, practitioners, all that kind of stuff, which are usually economically resilient employers. This was the slide I was looking for. So it's becoming a technoplex, meaning major high-tech hub. There's startups, there's a lot of tech industry, and it's helping spur the Texas economy. So we'll go through this. There's a lot of different projects. This is the Dallas Park Bridge. Economic impact about 300 billion. Beautiful park, sort of think Central Park for Dallas. Baylor Scott White is a healthcare network. They are employing 6,000 active physicians, 40,000 employees, $2.5 billion of annual impact. McKesson, one of the big leading healthcare companies, decided to move from California to Texas, similar to how Elon decided to move a lot of his companies to Texas. And so there is a migration, there's a flight from California due to the regulations, and Texas is the recipient of that transition. DFW, if any of you guys have flown through it, pretty busy airport. I didn't realize this until we were doing the research for this webinar. Third busiest in the world, $37 billion of economic impact. Tons of attractions, because I really want to get to some Q&A. Okay, the World Cup is coming to Dallas in 2026. They're predicting a $400 million impact. A lot of battery and storage is happening for electrical vehicles. And this company, Hexagon, is producing some of that. UT Southwestern Medical Center, this is interesting. A $5 billion pediatric health campus in Dallas is being created. They plan to care for over 3 million children in the Dallas-Fort Worth area. And they're building a $4.5 million square foot campus. Obviously, a lot of attractions, including the aquarium, botanical gardens, Dallas Museum of Arts, Dallas Zoo. If you guys are into clubbing, or if you're not old like us, then perhaps the nightlife would interest you. But the interesting thing is there's a lot of nightlife with the $15 billion economic impact. One time I went to visit a friend in Austin. He took me to a mechanical bull. But if you really want to ride the real bulls, then you need to come to Mesquite, which is the official rodeo capital of Texas. $600 million of impact, which I was not expecting. And in more than that, because there's so much impact, they're building more. So there's a huge $4 million upgrade to the complex. The school system here are phenomenal. We have Southern Methodist University, SMU, TCU, Texas Christian University, and many others. $27 billion of impact based on the university system. North Texas football, $2.1 billion to the national economy. And obviously, the most valuable team in the world, they say, is the Dallas Cowboys. Enterprise value of $9 billion. Generates about $1 billion of impact. Other sports teams, Texas Rangers, the Mavericks, the Dallas Stars. There's an MLS team called FC Dallas. Speedway. Keep going. We can go to. Okay, so this is important. The DFW is recently ranked as #1 for investor property returns in 2023. So that's important to know. And these are all the other highlighted cities. So as you can see, this is where Viking likes to hang out. These are the top cities that have the greatest returns. So as highlighted here, there's a huge election coming up in the next 30 to 40 days, right? So we don't know what's going to happen in the future. Will whoever comes into power renew the bonus depreciation? Will they reverse it? Will they get rid of it? I'm not sure, but I do know that you want to take advantage of it this year. It's 60% bonus depreciation, and it will help you save on taxes and maintain your wealth. And so there's multiple ways to invest, right? We have some assets, not necessarily this one, but we have other assets that are still available for you to consider investing as a 1031 exchange. You can invest in the trust, a self-directed 401k. If you have cash or savings, you have other assets that are not performing, you can liquidate them and invest here. Self-directed IRAs are also acceptable. There are many ways for you to invest with us at Viking Capital. So check out the links, guys. We have links to book a call with my team. Chris, Amir, Hayden, Amber, we're all on standby, ready to answer your questions, take you through the underwriting, answer your specific financial situation, and see if this investment makes a lot of sense. Scan the QR code, and the cool kids like to do this text stuff. So you can text Townhomes. And with that said, I really want to dig into some questions and make sure you guys feel comfortable with everything we've talked about. So let's get into it. Do we have any questions here? Let me see if I can pull up a few one. Okay, so
one question came
Yep.
across the screen, which is why is the seller selling? Question that we always ask. Here it's a pretty simple story. There's actually the owner, their largest investor is an institutional investment firm that, given their probably fund-based, they have to recycle their capital. They can't leave it in long-term investments. So they've determined it's time to recycle the capital, time to sell, invest in the next deal, and that's why they're selling. Simply the institutional group who fronted most of the money for the seller is moving their capital on to another opportunity.
Okay, I got another question. So I'm going to feed you guys questions. You guys spit out some answers for our investors, okay? So let's do this. What are the anticipated demand risks for BTR as interest rates fall over the 3 years? So either one of you guys can tackle that.
So thankfully, this one's kind of really protected on both sides. Interest rates stay high and people can't afford monthly mortgage payments. They're going to stay in rental properties longer. Interest rates come down and the single family home or the single family townhome market shoots up. We have the optionality to now sell these individually as townhomes. So one of the biggest risks to BTRs, as you mentioned, what if all of a sudden no one wants rentals anymore and house prices, all of a sudden everyone can afford a huge house? Well, guess what? We can now sell this as an individually parceled home. So we have that protection on both sides of the interest rate equation.
Hey, Tim had a really good question. He goes, the 5 to 6% cash on cash seems pretty conservative. Any provisions for higher distributions of profits are strong, Chris?
Yeah, I think that given a scenario where we're bringing on more cash flow than anticipated, the 5 to 6% cash on cash is a projection. If we're bringing on more cash flow, we would increase the distributions.
Absolutely. Yeah, and the thing is, we've been in business long enough to where our goal is to try to present as accurate a picture as possible and get you guys to make sure you feel comfortable. We always like to over deliver, but the goal is, compared to some other shops out there where there's a lot of glitz and glam, and then finally it's underwhelming when the returns come. We try to be very conservative, but thank you, Tim. We got a question here. What has been your experience? This is probably a Judah question. What has been your experience with surging insurance costs in the Dallas area?
Funny you ask that question. So actually, Dallas is not nearly as surging as other markets in Texas because we're more north. We don't have the Gulf to worry about like Houston does. We don't have the same kind of a volatile weather, believe that other Texas markets might have. DFW is actually a little bit more stable weather market. So on the property side, not as much of a concern. Same thing on the liability side, strong, very much strong across Texas. In fact, we just got one of our insurance quotes came in at $200 less per unit per year than we had anticipated, simply because it's an insurer who insures one of our other Texas properties. They're also already on site now. And given they already know the property, they've been very competitive. So again, Dallas is not nearly as volatile as South Texas or parts of Florida or other parts of the Gulf. But we already have quotes. We already have that kind of fixed in place and ready to move forward on it.
So I'm gonna take this question. It goes, do you have in-house property management or is Viking fully vertically integrated? Over the years, we've started to become more vertically integrated. We've had some partnerships with a third-party property management company that really values the scale and the scope and the size we've become. And so essentially they've created an internal team just for Viking Capital. And this team goes with us with all our properties. The team is branded as Viking Capital. The name of our assets always become Elevate. And we have an in-house construction team that we control as well to do a lot of some of the heavier renovations. And we have an asset manager that is essentially operating in a much higher level way where he dictates what he needs to the regionals and the local managers. And so this is how we've been able to cut costs, be very efficient, and really keep a pulse on our assets. All right. Here's a question about any oversupply concerns over 2025 and 2026 in the submarket. Judah.
Not really, simply because, as we mentioned earlier, the webinar, and if you didn't get to see it, I recommend you watch the replay or at least get the deck. There is a vast undersupply right now. I think the best case scenario is that maybe they reach an equilibrium. Again, we have a 5-year investment period. If we had a 50-year investment period, and there are a lot more differentiations of projections of where it can go. Over a 5-year period, given kind of the where things are, also the deliveries expected in this part of Dallas aren't a lot of projects in the work right now. So we feel very comfortable that we'll have that demand exceeding supply throughout our investment period.
Very good. There's a question about expense ratio of 49%. Is that accurate? The 5-year performance shows it to be much lower.
So right now it's about 49%, and possibly we have it staying about there. That's conservative. Generally, in newly constructed properties, you'll see that dip into the 30s. We could project 30s. That's reasonable, but we've kind of made sure that we had sufficient capital allocated to the operational expenses, that we were reserving enough of the revenue for our APEX. Is it a little high? Maybe, but we're happy to keep it there just to make sure that we're a bit conservative on that front. If this operates like other properties should, at a lower OPEX ratio in the newer part of a property's life cycle, that'll only kind of drive further cash to our bottom line.
Chris, I'm going to ask you a question. He's discussing about how sponsors and how we're going to participate in the deal.
Yeah, the way that Viking does all of their deals is the general partnership puts in about 10% at least of equity from the equity raise. So this one's going to be 17 million. You can expect the GP to have at least 1.7 million. In many cases, it's more. And that's a capital contribution. Is that the answer to the question you're looking for?
Yep, absolutely. And then Judah, I'm going to ask you this more on due diligence. The average income of tenants, I know around that area is about 70,000, 80,000, something like that. About 75, I think, is the number I had. But Judah, do you have any more data on the average income of tenants?
Yeah, we just fed every single lease into our software at the end of last week. And that's a third-party company we work with called HappyCo that parses through a ton of information. We hope to have that. If anyone wants to book a call, we should have that by middle next week, because we actually find out the verified income of every single tenant on site, of every single family on site, if there's more than one income earner. And we expect this one to be at, if not hopefully above, the median income in the general market. Given you have more people living in the units, usually you will have higher incomes.
Yeah, there's a question about Viking's presence in Texas. So listen, we've done some deals in Dallas with a prior partner early in our career. We were a JV where we brought a significant amount of equity to the deal. But this is our first sponsorship deal where this is just Viking's deal fully. But prior to this deal in the Bluebonnets, and speaking of which, guys, I was very challenged when I heard the name, but then I realized it's the state flower of Texas. So that's where that came from, the Blue Bonnet Trails. That being said, we had a deal in Austin that we sold for a profit called Reserve at Walnut Creek. We then bought a deal in San Antonio called Elevate Humner Grove. And after that, we bought a deal in Houston called Kings Cove. And then we bought a deal just recently this year, villas at Sundance, right between Austin and San Antonio. And then finally, this is our transaction in Dallas. So we have a major presence now in pretty much all the major markets in Texas. Someone is asking, if the property is not doing well, maybe I'll ask you this, Chris. If the property is not doing well, why not refinance? Sorry, if the property is doing well, why not refinance return capital to reinvest and keep good asset? Investors don't like paying profit to taxes and then having to look for a new asset.
Yeah, I mean, I think it's two-sided, right? If you're talking about the current owner, my understanding from the broker was that they have a variable rate loan and they're looking to sell before they pay for a rate cap extension. If you're talking about us selling the property in 5 years, while we would look at a recap, that's always a possibility. Really, there's usually a kind of point of diminishing return to where holding the asset for another 5 years isn't going to create the same return profile than if we sell the asset, return your capital, get you the return that we projected, and then help 1031 that money into a new deal that's going to create better returns for you over the next 5 years. That's really the way we look at it.
Great. And then I think we'll ask one more thing. Why don't you just, Santiago's asking a good question. Just, can you just overall give there's a lot of risks to different types of asset classes out there. Talk about this risk and maybe how it's been mitigated and adjusted based on the asset class.
Yeah, no problem. Listen, yeah, Wilson, I'll try and be transparent as possible. We love how big these units are. We get families, we get people living in them for longer. That increases the period of tenancy. And because people are moving out less frequently, it reduces our frequency of turn costs. However, when we do have to turn a unit, you have 1,843 square feet you have to turn, right? So your cost per turn is a little higher because the carpet you have to replace, there's more of it, right? Then when you have to repaint, there's more surface area. So in terms of the upkeep per unit, it is a little bit higher because they're larger units. But again, the savings it drives because people stay there longer outweighs those increased costs.
We've really tried to do our best to de-risk it. We've chosen a great product in a very good submarket within a very good major market. And then we found something that's 97% occupied that still has value to push rents at $200. And managing this will be a lot easier than some of our assets we've had to manage. So I think this will be a very good deal for investors. I think it will fill up very quickly, especially once we do the second webinar to the general public. So I suggest getting into this deal soon. I mean, it's probably, I don't know if we're going to be able to do another deal this year. We'll do our best to try to find another one, but probably this may be the last deal. So if you want that bonus appreciation, definitely take advantage of it. Book a call. Multiple ways to do so. I'm going to let you guys enjoy your evening. Hopefully these Q&As have been helpful. The full Q&A can happen when you chat with our team, because then we can go into your individual story case and there's no time limits there. And so thank you guys. Appreciate you. Love all the support. Looking forward to you guys joining us on this project. And with that, thank you, Judah. Thank you, Chris. Thank you, AV team. And I hope you guys have a really good evening.
Have a great night.
Thanks, everybody. Good night.